All right, folks, my name is Bruce Stinger. Hope everybody's doing well out there. It is really going to be an exciting interview that we have here with Michael Mikhail. So before I bring Michael on, one of the things I want to do is just talk a little bit about him and give you a little bit of background about why you should get your pen and paper out right now and take notes, because this man is very, very powerful. He's going to drop some gems, I know. So Michael Mikhail, he's an accredited lender in the mortgage world and a very, very seasoned real estate investor with over 20 years of experience in the industry. He currently serves as the founder and CEO of Stratton Equities, which is now write this down, guys, because it's a leading nationwide direct private money for real estate investors. That's right, real estate investors, just like you and me. So I know I'm going to be collaborating with Michael on several deals. So Michael, here's the interesting thing is Michael has built really Stratton Equities into a resource for borrowers, brokers, and loan officers. His passion for helping others succeed in their investment goals, it has inspired him to create a company with the largest library of loan programs under one roof. Now, I always say, as an entrepreneur, you never know where the inspiration is going to come from. And when Michael purchased his first home at 19 years old, he went ahead and traveled around the globe, visited 19 countries, all within 5 years. That's amazing. And Michael became very, very inspired by the idea that he should start his own business right here in the United States. So Michael went ahead and he continued to follow the mortgage industry's transformation resulting from the different regulations that were presented between 2008 and 2012. And Michael knew at that time it was time to seize the opportunity. So he founded Stratton Equities in 2017, and eventually he grew it to be one of the leading companies in the mortgage and real estate industries. So welcome, Michael. It is beautiful to have you today. Thanks for taking some time to spend with us. And I know Stratton Equities is really well known in the tri-state area, but for our viewers today watching from all different parts of the country, tell us a little bit about Stratton Equities. And again, a pleasure to have you with us.
Thank you. Appreciate the intro. Stratton Equities is as you said, we're a nationwide direct private money and non-QM lender. We specialize in investment financing. So 1 to 4 family, mixed use, commercial, multifamily. We're very niche in what we do. So we get a lot of people that reach out to us for either cannabis or different things. We don't do that. We stick to what we do best, to what we have the highest LTVs and the lowest rates on, and what we know the best, which is primarily investment and small balance commercial properties.
All right. So owning commercial properties, Michael, none of the smaller like individual homes.
Yeah. So 1 to 4. So that's 1 to 4. So 1 to 4 investment, mixed use investment, multifamily investment. But when it comes to commercial, we're specialized in small balance, meaning under 5 million. So mixed use, retail, office. Again, it has to be something that you're going to be renting, right? We do owner-occupied commercial, no owner-occupied 1 to 4, so you can't live in it, or even a 5-unit where you live in it, we can't touch just with our licensing. But if it's small balance commercial, like we've done medical offices where a doctor's going to be using it, or an office building where somebody's going to use one of the offices, so owner-occupied commercial we can do, and that's really our niche and that's our specialty.
Very, very nice. Now, are there any areas of the country, Michael, that you will not invest in?
Yeah, so we don't lend in just due to licensing. We don't have Nevada, Utah, Arizona. We pulled out of just after COVID, Hawaii and Alaska. Pre-COVID, we did some stuff in Hawaii and Alaska. We pulled out of Hawaii and Alaska. And that's really so, and North and South Dakota. So whatever that is, 6, 7 states that we don't lend in. So we're pretty much in every single other state.
Gotcha. Now on the commercial side, Michael, what does a sweet deal look like for you? What is a deal that you're like, boy, I'm lending on this one here?
Yes, small balance commercial. I mean, FICO is always going to be important. So we do look at FICO. We do have programs where FICO isn't important per se, which is our true hard money bridge program. But that's no here nor there. That's a program where that's worst case scenario. It's pretty much our foreclosure bailout program. So we do foreclosure bailouts. That pretty much goes under the same program, which is our extreme hard money program. But if you want a term loan, so a 5/1 or a 30-year fix, you're gonna have to have at least a 650 FICO. Obviously, higher the FICO, the better. We love multifamily. We do a tremendous amount of multifamily deals. A big thing is, generally we have one borrower with multiple deals. I mean, I haven't done a loan in 2 years myself. We have a full sales team, but I did a loan for one gentleman in Florida. I think it was 46 or 45 properties were for one investor. So we get a lot of repeat business, and we like that. We like to work with somebody over and over again. We have great terms. We have no junk fees, no upfront fees. We don't charge anything upfront. The only thing that's charged is the appraisal. So people know, how we treat our borrowers, our brokers, and our clients, and we get a tremendous amount of repeat business.
Is a pretty quick turnaround, Michael?
The problem everybody's having right now is appraisals. I mean, pre-COVID, we were closing, bridge loans in, I don't even remember, 10, 15 days. Appraisals, no matter where you are, right? Because everybody has to go to an AMC. You have appraisers that are just very difficult right now. They're picking and choosing where they want to do business. They're making it very difficult. That's the way it's been since we got back from COVID. When we got back from COVID, title was a headache. There's a lot of municipalities were closed, and it was hard to get title for some smaller, areas. But we have a great relationship with our title companies. But the biggest hurdle for everybody right now, since COVID, has been getting the appraisal in. So an appraisal will take a couple of days or a week. Sometimes they take 3-4 weeks. I mean, generally we're getting them in about a week and a half, 2 weeks. But we had some locations that were out there a little bit that weren't metro areas where the appraisals did take longer, which then of course pushed the closing. I love when we see these companies, we close in 5 days. No, you don't. No, you don't. I mean, I see this all the time. So no underwriting, no processing, no documentation. You just somebody applies and you just give them $1 million. Like, I mean, come on, stop lying.
Exactly. Exactly. That's the truth, isn't it?
I've never overshot things. We've never said things we can't do. A big thing why borrowers and brokers love working with us is the loan officers here go through the most extensive training in the industry. They are trained of what we can and can't do. We can't do it. We tell you we can't do it. We don't do, okay, let me see who can do it. Let me call around. Let me call broker it out. We don't do it. If we can't close a loan in-house with our programs, it's a dead deal to us. And we don't drag people. And I mean, yes, sometimes something gets submitted and then you have something in the underwriting that the loan officer couldn't see. But for face value, when we submit a loan, we know that it fits our guidelines and it fits what we do.
Right. Now, Michael, I asked you earlier, what areas would do you not invest in? What about, are there any areas that you are more that are kind of like more of your favorite areas to invest in, or areas that you've invested more in?
Florida. Southeast Florida, parts of Texas, Dallas, Fort Worth, obviously the tri-state area. We do a lot of business in the tri-state area. It really depends on the programs. Right? Some programs we have, the property can be rural. Some programs it can't. And again, the loan officer knows that. We have software. We are loaded up with software. The amount of software we have is ridiculous. So we know where we can lend. The loan officer will get the address, punch it in. We'll know where we can and can't lend due to whatever demographics and different reasons or population. Sometimes you have a population of 200, or 100 or 1,000. So it depends. Some programs might not be able to fit for that. But again, that's why we have very extensive training for our loan officers, and they know what we can and can't do. Actually, they know more than me at this point, to be honest with you, because I've been out of the guidelines and underwriting for a while. They know more about what we can and can't do at this point than even me at this point, because they go through a lot of training.
Yeah, very, very good. Did COVID affect your business at all, Michael, over the last 2 years?
We were shut down. So we're lucky because a lot of lenders in my space went belly up. A lot of lenders closed up, for one reason or another. Permanently. We actually shut down from when COVID hit, whatever that was, middle of March. Our lines all froze. So we couldn't lend from March till August. So we were shut down March till August. We got back in August. But even when we got back in August, everybody had the same thing. LTVs were low, 60, 65 LTV. Rates were high, costs were high. The cost of capital for us was high. People don't understand how that works, right? So, if our costs are high, then we got to pass that on, obviously, right? So I can't give you a 4% rate if I'm getting it at 6%. So, the cost of money was much higher at that time. Now, rates are better than pre-COVID. LTVs are higher. Like pre-COVID on a term loan, we were at 80 LTV. Now we're at 85. We're the only lender that I know that does an 85 on a 1-to-4 family on a term loan, so 5-1 arm, interest only, etc. So we're at 85 LTV. Great program. Things are I mean, the big thing now is if somebody is not paying their mortgage, we're looking into that, or they, missed payments or something. So that's something. So there's been a little bit more tweaking on guidelines on underwriting to be a little bit more extensive on people's background of, are they paying? Did they defer the payments? Did they get a payment plan? So we're kind of looking at that. But other than that, rates and LTVs are better than pre-COVID, which is great for everybody.
Yep, it is. Well, good. Michael, it's obviously you have a lot of experience in this industry. How did you get started in the finance industry?
That's a very long conversation. So I owned a car wash in Jacksonville, Florida in 2001 or two. I don't recall. Things happened. I had to come back up north. And I was talking to a friend of mine who worked for Wells Fargo, and she said, business, real estate, you're good at this and that. Why don't you get into the mortgage industry? This was 2002 or three. And I said, I know nothing about mortgages. I thought I knew nothing about mortgages. And, that was during the boom. And I put a resume together. I was 22, 23 years old and went to a bunch of interviews. Most people only wanted experience. I had no experience. And one company was willing to train and gave me experience. I still remember the day I got hired, which was August 4th, 2003. I don't know why I still remember that date. And, that was it. I was in the business till 2008, till the crash. When the crash happened, I got more heavily into buying real estate, which was obviously a great time to buy real estate in 2008, 9, and 10. I'd left the US in 2012 when I did my traveling of 19 countries in 4 or 5 years. Came back 2017, went to work for a mortgage company in 2017, a commercial mortgage company. And I just saw, I just saw there was a better way to do this. I just saw what they weren't doing, what they were doing, how companies were operating. And I can't really explain it. It just clicked in my head that there's a better way to market and run a company in this niche. And I did it.
Love it. Now, Michael, I have to ask you, because in the background, I keep staring at Stratton Equities, and it's such a strong name.
I will give
How did you come up with that name? What's that?
I'm glad you asked that question. So in my trip, I was in Australia. I was in Sydney, and I met a gentleman that when I met him, he was worth, I think, $3 or $3.5 billion. And he owns the largest financier company in Australia, which was just called Stratton. And he started financing cars in middle of Australia in like 1964, 65. The guy was like 75 years old when I met him. And he just had the name Stratton, and I loved the name, and I incorporated the name. So when I started Stratton Equities, we were backed by 3 equity groups, 3 hedge funds, 3 equity groups. I'm literally sitting in a cigar lounge at 9 o'clock in the morning in 2017 and, thinking of what name I'm going to use. And I loved the name Stratton from Australia and the equity groups. I put Stratton Equities together, and that's really the story.
Love it. Good name. Really, really good name.
Thank you.
So let me ask you this, what are some of the deals that Stratton Equities has been a part of that you're most proud of?
Right now our volume is high. So I don't get to see, I have so many people that are under me. I don't get to see every single deal unless there's generally a problem. But previously, we know how to structure loans, which came from me, because I've always been very good at structuring loans and finding, like, I'll give you an example. We don't structure a loan via email, and that's company policy, right? We get 200 emails a day. Here's a scenario. You cannot structure a loan, especially in the private money space where there's a lot of ins and outs, via email. You have to have a deep conversation. You have to discuss the ins and outs and then learn why. When somebody comes to a lender like us, there's something that's happening. There's generally a problem. There's something, right? We don't do cookie cutter clean deals. So if you're coming to us or anybody like us, especially us, there is a reason why you're knocking on our door. So this is not the type of scenario that we can structure with a couple of sentences via email. We have to dig in and learn, and it's a long conversation, understand the pitfalls and why you couldn't get approved and all these things. So we understand and we learn how to structure loans that are harder than other companies, because our loan officers are trained very well and they know what to ask and what, like most, like I'll give you an example. I remember I apply, like if you go to a bank, right, a regular bank, and you apply for a loan, the loan officer knows nothing about underwriting, right? So they'll say, yeah, apply. So they apply, they submit the application, and then you get denied. Well, why didn't you tell me I was going to get denied on ABC? Like, why didn't you know this ahead of time? And most loan officers, especially in the QM, owner-occupied, Fannie and Freddie world, all they do is look, you get the application, they throw it in, and they go, okay, then underwriting figures, oh, we can't do this loan, which clogs up the company, pisses people off, demotivates a loan officer. You have to have many more back-end staff to manage all this volume of loans that don't close. We don't do that. We know upfront. We ask the questions. We don't do things via email, right? So you can submit via email, but like we get people that submit a whole package to us. Like, we're not going to just take that and just shove it into underwriting, right? That's not how this works. We got to know the deal. We got to talk to you, make sure it's a viable deal, ask the questions. Like they'll let you send you, property in New Jersey. Can you lend? No information. Don't know anything about the deal. Yeah, sure, we can lend. Like, so, we don't, and a lot of people, they do that. They just take an application, somebody shoved to them, and they throw it into underwriting. We don't do that. Our loan officers are trained to kill loans up front that aren't going to move forward. That we don't just throw, when we bring, so we have 4 stages into our loans. When a loan gets submitted into processing, which is stage 3, and then it goes into underwriting, that loan is solid. It is solid. We know everything. I mean, rarely do we get things that die when they hit that stage, unless there was something nobody could have seen. But we know what's happening. We know that this loan's going to go through. We do not just shove whatever and just hope it sticks.
Yeah, makes sense. Makes a lot of sense. Michael, are there any new, industry developments investors you think should be aware of? I mean, what kind of insights can you give?
Is the ADL. So, I pioneered soft money. Everyone knows hard money. I pioneered soft money. We've done a lot of PR and interviews on soft money. Soft money is pretty much a hybrid between hard money and conventional. So it gives you the benefits of less underwriting, less guidelines, but with the higher LTVs and the lower rates of a conventional loan. So our loans now actually drop. All of our marketing says 3.75. I think recently we dropped to like 4.125 or 4.25, so it's even lower actually. But our soft money program is strong. 85 LTV. Less documentation from the borrower. We don't look at income docs. We don't look at W-2s, tax returns, pay stubs. We don't look at recent employment. So if you moved around, again, I structured the lending for an investor, right? Most investors don't have great tax returns, right? So they can't go to a bank. They have an LLC, they formed an LLC, so they don't have 2 years or 3 years of history the way a bank or a traditional lender wants, and they're never going to get a loan, right? Also, you got to look at investors, because I am one, move money around a lot. If you go to a bank or a traditional lender and you move $1 around, they're going to probe the hell out of you from now till next Sunday on why and who, and I want that, I want this. Like, we make it much easier for lenders to secure financing.
Very, very good. Excellent. What do you think investors, you also are an investor, so what are you doing to prepare for this current inflated market that we have?
I'm not buying. We don't buy. I'm sorry, it's not time to buy. I mean, I don't buy. I right now, advice that I would give to an investor is prepare yourself, stock as much cash as possible, make sure you have as clean as a credit as possible, and wait for the downturn.
Gotcha.
That's what I'm doing. I mean, I own Stratton Realty. Stratton Realty is my investment arm. I haven't done much. I mean, the company's obviously established, but I haven't invested on the Stratton Realty in some time now. And listen, what goes up will come down, right? Things are too high. Also, you got to realize, right? There's a lot of lenders that all they had was the fix and flip. Fix and flip. I don't know how many. We barely have any in our pipeline right now, because to approve a fix and flip loan, you have to buy the property significantly under market value. Investors are not able to buy property under market value right now if everybody's overbidding things 60, 70 grand. So the investor can't get a deal because you have end users, right? Regular users that are buying the property 50 grand over value. So the investor can't get a good deal, significantly under market value. So the numbers on a fix and flip are never going to get approved. And you had a lot of lenders where they didn't have our wide range of programs. All they had was the fix and flip, and they're dying right now because there's no fix and flips.
Yeah. Yeah, that's true. I see that. I mean, I'm in the business. I have probably a little bit over 200 deals under my belt. all across the country. And it gets harder and harder these days to find a good deal with meat on the bones. That's for sure.
You see, I'm a selfish investor. I want a killer deal. I don't do things that a little bit margins. I want a home run. There are no home runs right now. You're not going to get one.
Yeah, it's true. What words of caution for investors do you have? And maybe learning even from other investors that have made mistakes that you've seen. What words of caution would you give to others?
I mean, one of the biggest thing is, to me, it's all about the numbers. I bought 56 properties, and Stratton Realty will do a lot more business when the time comes, but I have no emotional attachment to real estate. It's all about the numbers. One of the biggest things you see is an investor that's just dying for that property, and they will go to 100 lenders. Let it go, man. Let it go. Go to stuff that's lower hanging fruit, that has better numbers. You can't get emotionally attached to anything when it comes to finance or business. It's all about the numbers, right? So I have no emotional attachment to these things. It is just literally, do the numbers work or do they not work? If it's an impossible deal, if your gut, listen, I listen to my gut. I'm 40 years old, and I've learned a long time ago that I have a great instinct and a great gut, and I always listen to my gut. If your gut says you're wrong, just walk away. See, I don't care about the money I can make. I care about the money I can lose. Right. So people always worry about, how much can you make? I get 5 people a week to come to me for some deal or some investment. I don't care about what I can make. Right. I care about what I can lose. How much am I at risk? What am I at risk to? That's what I look at. That's what I care about when I do anything. Right. I don't care. Am I going to make $1 million? I care. Am I going to lose $100,000?
I think that's a really, really good approach. Very good. What's the best way for our listeners to be able to contact you, Michael?
StrattonEquities.com, which has all of our contact information, which is our main website, 800-962-6613, which is our phone number, which will ring directly to a loan officer, info@StrattonEquities.com, where we get emailed. But of course, the website, www.StrattonEquities.com, that's the best place to reach us.
Love it. Well, Michael, you got a lot of great energy, a lot of great experience. It's been a pleasure to interview you today. Is there anything else that you want to add, leave with our listeners?
I did an article a short while ago about being a better investor. And I'm sure you've seen people that, aren't financially in a great spot and are just dying to get a deal. If you want to be a successful investor, take a step back, put money in the bank, have enough liquidity, have your ducks in order, have good credit, right? Credit is key. Have your ducks in order, have all your paperwork ready, and have a team, right? You got to have a good CPA, you got to have a good bookkeeper, a good attorney, have your team, become a stronger, better investor, and it'll be significantly easier to go out into the marketplace, secure financing, and get better loans and better deals.
Very good.